specifically, we're going to start with that question there. We start with the question for August of 2022. August 2022. And this was question number what? This was question number 4. Question number 4. So if you are here, please confirm. If you have the question with you, just confirm. Just confirm whether you have the question. Yes, confirmed by Elizabeth. Confirmed by Patrice. Okay, so what are we told as far as this question here is concerned? What are we told here? So the question reads: Tagga Limited is a private company, private limited liability company operating in telecommunication industry. The company has suffered successive trading losses for a number of years, largely due to stiff competition. Yes, that's what I'm recording. Largely due to stiff competition and a sharp decline in the revenue. So we are told the directors of the company, who are also the main shareholders, agreed to restructure the company by transferring it to a new company to be named 𝐎𝐍𝐻 Limited. So automatically, this is an external reconstruction because this company, which is called Tagga, we are told it will be restructured by transferring its business operation assets and liabilities to a new company, which is called 𝐎𝐍𝐻 Limited. So then you're told the statement of financial position of Tagga Limited as at 30th of June 2022 was set out below. So we're given the statement of financial position of that company before the reconstruction. We have the non-current asset, current asset, we have equity, non-current liabilities, and current liabilities. Then we have additional information number 1 all the way to note number 9. And basically, if we go through this particular note here, whatever you're given in note 1, note up to note 9, and basically you compare with the other question which we did, you'll be able to see the notes are almost the same. The notes are almost the same because I say these questions for external reconstruction, they are the same. So the examiner will just try to change very few items, but essentially the questions are the same. So what are we required to do here? Part A, we are required to prepare the following ledger account to close off the books of Tagga Limited. Roman 1, the realization account. Roman 2, ordinary shareholders salary members account. Roman 3, the preference shareholder salary members account. And then part B, we are required to make the journal entries in the books of account of 𝐎𝐍𝐻 Limited to record the acquisition of Tagga. If you can remember the other question which we did, the examiner was not requiring the student to make those journal entries. And then part C, we are required to prepare the opening statement of financial position of this company, of the new company, as at 1st July 2022. So remember what we say is that once you come across such a question for external reconstruction, basically I think I talked about a number of steps which you need to follow. Number 1, we said compute the purchase consideration. Compute the purchase consideration which the new company is supposed to pay the shareholders and the financials of the old company. Number 2, close off the books of account, books of what? Of accounts of the old or the selling company. Of the old or the selling what? Company. Now, after doing that, like this particular question here, you have now to proceed and you make the journal entries. The journal entries to do what? To open the books of account, to open the books of accounts of the new company. The new what? A company. And then finally, you prepare the statement of financial position equally for the new what? A company. Essentially, these are the steps you should follow. But we said in an examination setup, I will not advise you to compute this because if you can remember the question we did yesterday, I think you can be able to recall how computation of the purchase consideration was demanding and also it is time consuming. So therefore, if you happen to come across this question in an examination setup, avoid computing this. Even without having computed that, you'll be able to get good marks, basically over 15 marks, without having computed that purchase consideration. So what we need to do basically, we will go straight to closing of the books of account of the selling company, basically by preparing the relevant ledger account. So those are the ledger accounts we require to prepare in Roman 1, the realization, ordinary shareholder salary members account, the preference shareholder salary members account, to close off the books of account of the old or the selling company. Then from there, we are going to make the journal entries for the journal entries to open the books of account of the new company. And finally, we prepare the statement of financial position of the new company. We'll be able to see that by using that particular approach, that question you should be able to do it within 30 minutes. You have more than 15 marks, you move to the other question. So therefore, you move to this one to cross off the books of account of the old company. But before you do that, it is important for you to recall what you're told in paragraph 1. The company which is to be structured is 𝐎𝐶𝐒. This is a company which has been making losses, and this is the company which is to be liquidated. Its business operation, assets, and liabilities taken over by a new company, which you're told will be known as 𝐎𝐍𝐶 Limited. 𝐎𝐍𝐶 Limited. So therefore, this is the selling. In other terms, this is the old company, whereas this is the new. In other terms, we refer to this as what? As the purchasing company, as the purchasing company. So the first thing we need to do basically is to cross off the books of account of 𝐻𝐶𝐒, and we do that by preparing the ledger account we are required to prepare as per Roman 1 of that question. So we move to, or basically we go straight to Roman 1 of the question, and we are required to prepare the relevant ledger account to cross off the books of account of 𝐻𝐶𝐒. So part A of the question, ledger account to do what? To cross off books of accounts of who? Of 𝐻𝐶𝐒 Limited. So which ledger account do we prepare? The ones which are listed there. The realization account, we are going to start with the realization account. The realization account. Then from there, we will prepare the other ledger account, which is called the ordinary shareholder sundry members account. Ordinary shareholders sundry members account. So we don't have so many entries which we record here. And then from there, Roman 3, we are required to prepare the preference. The preference are shareholders sundry members account. The preference shareholders sundry members account. Yes. So basically, we said what we just need to recall is what we record in each of these accounts. And actually, we said when crossing off the books of account of the old or the selling company, what we do, we go back to the balance sheet, to the statement of financial position of this company, and basically we have to cross off all those particular accounts which had balances and whose balances are shown in the balance sheet or in the statement of financial position. Can we go back to the statement of financial position of this company? The information which we have, or actually the statement of financial position. Now, what we said, we start by crossing off the asset account. You can see under the non-current asset, we have two assets. We have property, plant and equipment, goodwill, and then current asset, we have inventory, trade receivables. Now, we say if you go to the additional information, you'll be able to see somewhere being told, or basically you'll be able to see a note whereby you are told, you are given information about the assets which were transferred to the new company, and those may be assets which were written off. Usually, or in our case, that is in note number 6. Even without reading all the notes, I can see that in note number 6. Can we go to note number 6? We are told the tangible assets were transferred to the new company at the following fair values. Which assets were transferred? They include property, plant and equipment, inventory, trade receivables, and then you're told goodwill was considered valueless and it was written off. So therefore, we go back to the statement of financial position. We have 4 assets, 2 non-current assets and 2 current assets. We know the PPE, inventory and receivables were transferred to the new company, goodwill was written off. Now, what we said, those particular assets which were taken over or transferred to the new company, we debit them here at the book values. The book values are the values we have in the statement of financial position, but it's also important for us to indicate that our values will be in thousands of shillings. So the assets which were transferred to the new company include the PPE. What is the book value for that? Remember, we said we use the book value or the carrying amount. The book value or the carrying amount are the values we have in the statement of financial position. Not the values we have in note number 7. The values we have in note number 7, we are going to use them when opening the books of account of the new company. So that's very important. So the book value for this is 59,500. 59,500. Then below that, we have goodwill. Goodwill is an asset which has been written off. We say those assets which are not transferred to the new company and they are written off. Basically, those assets are supposed to be debited in this account, not the realization, but the ordinary shareholders salary members account. Goodwill was written off as per note number 7. The value for that is 9,000. So then from there, we go to where we have current assets. The two current assets as per note number 6 were transferred to the new company. We debit them here at the book value. The book value are the values we have in the statement of financial position 18.5. And then this one, the trade receivables. The trade receivables is what? Is 14.5. So basically, we are done with the asset. We are done with the asset. So we say don't skip anything, because for the asset can either be transferred to the new company or written off. Those assets which are transferred to the new company, you debit them there at the book value. Those assets which are written off, debit them there at the book value. Then from there we go to the equity. So for the equity, we have the ordinary share capital. Ordinary share capital. Just a minute. Yes, so we continue. So basically, I've said we are done with the assets. We go to where we have equity. So equity, we start with the first item, which is ordinary share capital. Ordinary share capital, we say is crossed off to this account, and actually it should be credited. Ordinary share capital. So ordinary share capital, basically it should be credited here, and that is basically an amount of 60,000. So then below that we have 9% cumulative preference share capital. Preference share capital will be crossed off to that account, and equally should be credited in this account. It should be credited in this account. It should be credited in this account. The 9% cumulative preference share capital, and that is an amount of how much? Is an amount of 30,000. Then below that we have share premium. We said any form of any reserve should be crossed off to this account. Share premium and any other reserve, that one should be crossed off to this account. It should be credited here. Basically, we have 30. And then below that, we have accumulated losses. Accumulated losses is still a reserve, but that one, because it's a negative, it should be recorded on this side. Should be recorded on what? On that side. On that side, the accumulated losses. The accumulated losses. How much are the accumulated losses? 27,400. 27,400, like such. So I hope you can see we are done with the items of equity. Then for the items of liabilities, we have the bank loan and the current liabilities. So we must be given some information in relation to this. In most of the cases, we say liabilities, unless otherwise they are transferred to the new company, we must be given some information in relation to that. Like if you go to note number 7 in our question here, we are told the liabilities are non-current and current. The liabilities were taken over by the new company at their book value. So all the liabilities, the non-current and current, were taken over by the new company. So the liabilities which are transferred to the new company, we say they are credited here. They are credited here. We start with the bank loan. We start with the bank loan. So the bank loan is basically 22,500. And then we have the trade payables. The trade payables, which is basically 59. Then we have the tax payable. The tax payable, which is basically 3,000. We have the bank overdraft. The bank overdraft, which is 40, which is 45, which is 45. Now you can see what we have done. First of all, we have closed off all the accounts which had balances as per the statement of financial position, which is given there. Now, there are two other items I think we said we must always remember to account for here, because the other item which we should compute or basically credit here is the purchase consideration. But I've said don't bother yourself computing that. Ignore that purchase consideration, because if you happen to compute that, you'll consume a lot of time doing this question. It's not a must you have to compute that. You'll be able to get good marks even without computing this. Now, the two items you should always remember to account for is, in all questions for external reconstruction, you'll be told this company which is being restructured had not paid preference dividend for a number of years. So what you need to do, you need to compute the preference dividend in arrears. So this one must be given somewhere in the additional information. You just need to go through those particular additional information. Must be somewhere you're told you're given that information. Where do we have that? I can see it in note number 4. I can see that in note number 4. We are told the preference dividends in Tanga were 3 years in arrears, and the preference shareholders, in fact, we can just ignore that. We just need to know the preference dividends were in arrears for how many years. We are told the preference dividends were 3 years in arrears. That is our interest. The other information is basically for computing the purchase consideration, which you have said we need to ignore. So the preference dividends in arrears, we are told they were 3 years in arrears. How do we compute the preference dividends which were payable by Tanga? We are going to use this information about the preference share capital. The company had issued 9% preference shares, meaning the preference dividend to be paid each year will be 9% of this. That will give us the preference dividend per annum times what? Times 3 years, because they were in arrears for 3 years. Yes, that basically gives us the preference dividend in arrears for how many years? For 3 years. So let's work out this. So we have 9% times 30,000 times 3. And basically we are getting what? We are getting 81. So how do we account for this preference dividend in arrears? The preference dividend in arrears, we say they are debited here in that account, and then we credit them in this account. The preference dividends in what? In arrears. 81. The other item we should also remember to account for is to debit the liquidation cost here. The liquidation cost which was incurred in liquidating this company and paid by the old company should be credited here. You should also be given that in the additional information. Let's go to the additional information number 5. I can see it somewhere in note number 5. And you're told the liquidation expenses of Tanga amounted to 8 million and was basically settled by Elewa. So there was a liquidation cost of 8 million. Now these are the two additional items you should always to remember to account for, and which are not given in the statement of financial position. Now, once we are done with that, basically in our case, we are done with the part A. We are done with part A. Basically, that's what you should do in relation to part A. And now, if that question you leave it at that point, you'll be able to see that you can only maybe lose 1 mark or maybe 2, even if we have not computed the purchase consideration. Because, for example, in terms of how this account is marked, this is now the items which will be marked 1, 2, 3, 4, 5, 6, 7, 8, 9. How many marks are allocated here? The marks allocated here are 8. So the minimum marks you can be allocated. In fact, this is how this account is marked. Any marks allocated here for any 8 at half. Any 8 at half. Any 8 at half. Any 8 ticks. Each tick you get what? Half. It basically means that you need to get 8 ticks here. How many ticks do we have? We already have more than that. 1, 2, 3, 4, 5, 6, 7, 8, 9. So we already have 4 marks there. 4 marks there. Now this one is basically marked like this. Any 4, because the marks are located here at 4, any 4 at 1. Because I think just 2 items which are missing here, the purchase consideration and the realization gain on loss. So 1, 2, 3, 4. You can also see here, we already have 4 marks. And this account also is marked any 2 at 1. So I can be able to share with you the marking scheme. You can be able to see. So in that case, you can see we already have 2 entries. How many marks are located there? 2 marks. You can see within 10 minutes. Within 10 minutes, you should be having those 10 marks with you. You should be having those 10 marks with you. Now, once we are done with that, we need to move to the other part of the question, and that is part B. Part B. So what are we required to do in part B? In part B, basically we are required to make the journal entries to do what? To open books of accounts. Books of accounts of who? Of the new company. Remember, the new company is called what? Elewa Limited. So we are required to make the journal entries to open the books of account of the new company. Remember, you said that if you are required to make the journal entries, now Hodiek is asking about, now remember the other question we did yesterday. Now the double entry for this liquidation cost is debited here, and then the other entry should be in the purchasing company account. Check the other question we did, but you can see we are not required to prepare the purchasing company account. Are we required to prepare that, the purchasing company account? No. So that's why we are not completing that double entry. Sasa, yes, we are not completing that double entry. But in case it was required, then you have to prepare that and then you credit that amount in that account. Sasa, yes. So let's make the journal entries. Now, when making the journal entries here, you make journal entries basically for a number of items, which are obvious. So number one, account for the assets which are taken over. Number one, make a journal entry for the assets which are taken over at the fair value. Number two, account for the liabilities. For the liabilities taken over, liabilities are taken over at the book value. Number three, account for the liquidation cost, which was paid. Now, by basically accounting for these three items, you'll be able to score also all the marks here. So account for those three items: asset taken over, liabilities taken over, and the liquidation costs, which were they don't even bother going through the additional information there, because you can see we know the assets which were taken over, we know the liabilities which were taken over, we know the liquidation cost which was paid. But maybe you can also peruse through, you see whether there is anything you can account for. For example, I think in note number 8, we can see whether we can make any journal entries here. But basically, let's make a journal entry for those three items. One, we will account for the assets taken over. So we can say assets, instead of giving an addition, we can say what we are accounting for here are assets taken over, the assets taken over at the fair value. So how do we account for these assets which are taken over? Remember, we are doing a journal entry. We are passing a journal entry. Automatically, once the new company takes over some asset, those assets should be debited in the respective asset account. And then credited in the account called business purchase account at the fair value. So the assets which were taken over by our new company, we have those assets in note number 6. So the assets which were taken over, number one is the PP. So we are going to debit, that one will be debited in the PP account. At an amount of 55. Remember, values here are in thousands of shillings. So we debit PP. Then we the other asset which was taken over is basically inventory. That we debited in the inventory at an amount of 2,200. So then from there we have the other asset which is basically trade receivables, which is an amount of 14,500. Yes, basically I think those are the three assets from what we have here which were taken over. But there is something also you must be able to recall. If you can remember the question which we did yesterday, we said that once this liquidation cost which is incurred by this company, we say it is always paid by the new company. Now, once the new company pay for that liquidation cost, in some questions, not all, you can be told that the new company decided to account for that as a preliminary expense. So if it decided to account for that as a preliminary expense, it basically means that this company capitalized that particular cost, and therefore it recognized that as an asset. And what we say, therefore, you need to recognize that here as one of the assets which was inherited, one of the assets which was acquired from the old company. So what we need to do is to check whether this particular preliminary, this liquidation cost, was it recognized as a preliminary expense. So let's go to the information which we have in note number 6. We are told we are told the liquidation expense of Tanga amounted to 8 million and were settled by Erewa. Is there anywhere we are told that this particular cost was to be capitalized or it was to be treated as preliminary expense? Are we given that information? Yes or no? Are we given that information? No. But if we were given that information, then we include it here as one of the assets which was inherited from the old asset. That's yes. So then with the total amount, we credit the business purchase account. So with the total value of the assets which were taken over. So we have 55 plus 2,200 plus 14 plus 14,500. So this will give us 89,700. 89,700. Remember, we have already explained there above. We have already explained here what we have accounted for. What we have accounted for are the assets which were taken over. Number 2, we account for the liabilities which were taken over. Liabilities taken over. Remember, the liabilities we said are always taken over at the book value, because we say liabilities are not revalued. We say you cannot revalue a liability. For example, you can see that this company had a bank loan. There is no way you can revalue a liability. There is no way you can do what? Revalue a liability. So how do we account for this? How do we account for these liabilities which were taken over? So what we do is that we debit the business purchase account, we credit the specific liability account. So in our case, from the realization account which we have here, we know that we have how many liabilities were taken over, 4 of them. These liabilities. So we will debit the business purchase account. We will debit the business purchase account. And then we credit the liabilities account. So we have the bank loan. We have the trade payables. We have the trade payables. We have the tax payables. And then we have the bank overdraft. The bank what? The bank overdraft. So let's first of all, we credit those accounts. So the bank loan was, the bank loan is 22,500. The trade payable is 59. And then the tax payable is 3,000. The bank overdraft is what? Is 55, is 45, that is 45. Then we need to get the total and we debit it in the business purchase. So 22,500 plus 59 plus 3,000 plus 45. And basically that will give us 35. 900. So what have we accounted for here? We have accounted for the liabilities which were taken over. Now then from there, we also have this, and this is something you'll come across in all questions, the liquidation cost, which was paid by the new company. So make a journal entry for that. The liquidation cost, which was paid. The liquidation cost which was paid. A liquidation cost which was paid. Now, this liquidation cost, the liquidation cost which was paid, this one, number one, should be credited in the bank. Should be credited in the bank. And then from there, we debit an account called what? The selling company account. So the selling company, remember, is the old company. That should be the journal entry. So we debit the selling company. Remember, the selling company is the Tanga Limited. So account. How much is the liquidation cost? The liquidation cost is 8,000. 8,000. And then we credit the account which is called what? The account, or basically we credit bank. Remember, this amount was paid. We credit bank. We credit what? Bank. We credit bank. Now, once you make those journal entries, I think you can just leave it at that point. Just leave it at that point. How many marks are allocated there? The marks are allocated there are 6. So basically, this what will be marked 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So the minimum marks you can be given per entry can be half. So meaning that you're required, for example, for you to get 6 marks, you need 12 ticks, each half, and you get what? 6 marks. How many ticks do we have here? We have 11. So you'll get 5.5 to the nearest whole number, that will be 6. To the nearest whole number, that will be what? That would be 6. It basically means that by doing that, you already have all the marks. You already have the 6 marks. Now then from there, we proceed and basically prepare what is required in Part C. Can you see how simple this question is if you use that particular approach? Can you see how simple this question is? Basically to get those particular marks? Very, very simple. Very, very simple. So you can see already we have 10 marks here. We have 6. So we already have how many marks? We already have 16 marks. So then from there, we basically prepare what is required in the last part. In the last part, that is the statement of financial position. Opening statement of financial position. Position is at 1st of July. 1st of July 2022. 1st of July 2022. Now, equally here, I think we have so many marks which are free because, like, we know which assets were taken over. So all those are basically free entries. Here, we just need to post them here. So we just need to have a single column pair. We start by recording the non-current assets. So the non-current assets, we record the assets which were taken over from the old company, from the selling company. And remember, you said that we record those particular assets here in the books of account of the new company at the fair values. So these are the assets which were taken over here. So we start with the PPE, property, plant and equipment. This was taken over at a value of 55. Maybe the other item you can also include here is the preliminary expense. If the liquidation cost, which was paid by the new company, was capitalized, or in other terms, it was treated as a preliminary expense, also included there. But in our case, you can see it was not treated as preliminary expense. Then from there, we move, and basically we record the current assets. Now, for the current asset, I think we have these two. Inventory. Inventory basically is this value 20,200. What about receivables? And receivables, basically that one will also not change. 14 what? 14.5. Automatically here we may have other assets like the bank balance and so on, but no need of even computing the bank what? The bank balances. No need of even computing what? The bank balances. Then from there we move and basically record what? Record equity. Now for equity, I think we can be able to get this because in note number 1, and we go to note number 1, we are told that the ordinary share capital of 𝐍𝐻 Limited, which is the new company, is shillings 100 million. That is the ordinary share capital, comprising of 10 million shares of shillings 10 each. So then, basically what we know is that some of the shares were issued by this company to pay the purchase consideration. There is some information which we have in note number 8. Note number 8. In note number 8, we are told 𝐍𝐻 Limited, which is basically the new company, issued for cash and at par all the remaining ordinary shares not issued as part of the purchase consideration. The proceeds from the issue were used to pay the bank loan. So the bank loan will not appear here because you can see it was paid. But in this case, can we be able to compute the ordinary share capital of the new company? Yes. The ordinary share capital of this company will be equivalent to the registered, because we are told in note number 8, those shares which were not issued by the company to pay the purchase consideration, all of them were issued for cash and at par. So basically what that means is that the share capital of this company will be equivalent to the registered share capital as per note number 1. The registered share capital of this company as per note number 1 is 100 million. Is 100 what? Million. That will be the share capital. Then from there, non-current liabilities. Non-current liabilities. So this company, I think the obvious non-current liability we can have is the bank loan, but basically we are told this bank loan was paid. It will not appear here. It will not appear here. Then from there, we record the current liabilities. Now for the current liabilities, we have these current liabilities which were taken over, 3 of them. So automatically this bank overdraft was paid because there was money which was received. So that one was paid, the bank loan was paid. Maybe you can just check whether we have any other information about the 2 other liabilities. The trade payables, the tax payable. And I think there is no information that we are given about the payment of these 2 liabilities. They will appear here. So we have trade payables. Trade payables is basically trade payables is basically 59, and then we have tax payable. Tax payable, we have what? We have 3,000. We have 3,000. So now that question, that is part C, equally debate at that point. Equally debate at that point. Debate at that point. So how many entries do we have here? 1, 2, 3, 4, 5, 6. Even if, for example, you're given half, you can see you'll be having how many marks? You'll be having 6. You'll be having 3. You'll be having 3. But I don't think they can give half, because how many items may be missing here? This one bank, maybe goodwill. Those should be 2 items. Those should be 2 items. 2 items. Yes, I don't think they can mark it at half. Maybe it was marked at 1. So I've said for the bank for this ordinary share capital, see what you're given in note number 8. In note number 8. In note number 8. In note number 8 and also note number 1. So in note number 1, you're given the ordinary share capital 100 million. And then you're told in note number 8 that there are some shares which were issued to pay the purchase consideration, and therefore the shares which were not issued to pay the purchase consideration were issued for cash. By the end of the day, our company had issued all the shares. Our company had issued all the 10 million shares, each share having a par value of 10. That's basically why we are arriving at the share capital of this company as 100 what? As 100 million. As 100 what? Million. Sasa? Yes, as 100 million. As 100 what? A million. So basically, that's how we should approach that particular question. How we should approach that particular question here. And basically, by doing that, you should be able to get over 15 marks. Over 15 what? Marks. So using that particular approach, you should not take even more than 40 minutes to do that question. And then I'm saying that you should be able to get more than 15 marks. So therefore, if you happen to come across this question, don't bother yourself computing the purchase consideration. Just use that particular approach. Use that particular word approach there. Now, we have another question here for merger. A question which was examined in 2018. A question for merger. A question for merger. And this is a very, very common area. These are very, very common areas. So what you'll do, you'll also attempt this question on your own using that particular approach. May 2021, there is a similar question to this. May 2021, you do it using this particular approach. May 2021, question number 2. Do that question using the same approach. Actually, if you go to that question, I think you'll be able to see that the requirements are almost the same. We're required to prepare those accounts to cross off the books of account of SOARA, and then the statement of financial position. So this question does not require the preparation of what? Of the journal entries, basically to open the books of account of the new company. But let's go to that question for merger. There was a question there for merger. Yes, November 2018, question 2. November 2018, question 2. November 2018, question 2. November 2018, question number 2. November 2018, so you are there, please confirm. November 2018, question number 2. Yes, can we take a small breather of 5 minutes before we look on this one? Do we take a small breather? Yes, let's just take a small breather. We come back at 9:05. We continue. 9:05, we come back. We continue. Yes, so let's continue. I hope you are back. Are you back? So that we can continue. So please confirm whether you're back. Confirm whether you're back. Confirm whether you're back. Okay. So I want us to go to this question for November 2018, question number 2. This basically is a question for merger. And let's go through the question. We see what we are told. The question reads, B Limited and H Limited are private liability companies operating in service sector. They have been reporting successive trading losses for several years, principally due to severe competition, which has put downward pressure on their revenue. So the directors of the two entities, who are also the main shareholders, have unanimously agreed to wind up the company's respective business and amalgamate them into a new company to be named as S Limited with effect from 1st October 2018. So we are given the statement of financial position of the two companies as at the 30th of September 2018. That is B Limited and H. What do we have there? We have the non-current assets, which comprises of the PPE. We have the intangible assets, which are copyright. We have the current asset and the total asset. We have equity, which comprises of ordinary share capital, 7.5% cumulative preference share premium, and then we have losses. Then we have non-current liabilities, which comprises of 10% debentures, and then we have the current liabilities. Current liabilities comprises of trade payables and the bank overdraft. We have additional information about all the note number 10. So then what are we required to do here? We are required to prepare the following ledger account in columnar format. I'll be able to explain what you mean by that. To cross off the books of account of B Limited and H, realization account, preference shareholders salary members account, the ordinary shareholders salary members account. Part B, we are required to make the journal entries in the books of account of S to record the transfer of assets and liabilities. We are told to ignore narrations. So then part C, we are required to prepare the opening statement of financial position of the new company. Now, this one is basically a question for merger, because basically what you are told is that we have these two companies. As per the information we have in paragraph 1, we have these two companies, B Limited and H Limited. These companies have been making losses for a number of years, and therefore we are told that it has been decided by the directors, who are also the shareholders, to wind up these two companies and their respective business to be taken over by a new company to be known as what? To be known as S. So therefore we have B Limited. These two companies are merging, B Limited and also H Limited. These two companies are merging. Remember, in case of a merger, basically what happened is that the identity of the old companies disappear, and then a new company will be formed, which is known as what? S. So therefore, these two companies, because they are being liquidated, we refer to them as the selling, or basically the old company, the selling or old company, selling or old companies, whereas this one will be the new, or basically what? The purchasing company will be the new or the purchasing what? Company. So what we need to do basically is we cross off the books of account of these two companies, B and also H, and then from there we open the books of account of who? Of S. Now, when crossing the books of account of these two companies, B and H, we need to prepare the normal account, the realization, ordinary shareholders, the preference shareholders, and members account. But do we prepare those accounts for individual company? No. So what we do, we prepare a single realization account, but with the two columns. A column for B Limited, a column for what? For H Limited. The same case now to the other account, the preference and the ordinary shareholder salary members account. So therefore, we will go straight to part A of that question. And basically, we prepare the ledger accounts to cross off the books of account of these old companies. So part A, we are required to prepare the ledger account. The ledger account to do what? To cross off books of accounts, books of account of B Limited and also H Limited. B Limited and H what? Limited. B Limited and H Limited. So we will start by preparing the first account, the first ledger account, and that is the realization account. The realization account. Now, this realization account, I've said, we are going to prepare realization account for the two companies. That is basically B and H. So meaning that on the debit side, this is basically the debit side, we will have the details column, and then realization account for B. And it's always advisable to check how the information is given. For example, you can see we're given the statement of financial position for B, followed that with that of H. So also arrange your account like that, B and H. So the details, B and also H Limited like that. So then I think our figures are also in million of shillings. We will come here and we indicate that all our figures will be in thousand of shillings. Yes. So then from there, remember this is now what you require to prepare in Roman 1 of the question. In Roman 1. So in Roman 2, we are required to prepare the ordinary shareholders, salary members account. Also, we prepare this for the two companies, that is basically for B and also who? And H. B and H. So we have the details column, B Limited and H Limited. So the details are B Limited and H Limited, like that. Yes, and then next we have Roman 3. Roman 3, we have the preference shareholders. The preference shareholders, salary members account, salary members account. The format is the same. Details, and then we have B Limited, we have H Limited. On the credit side, the same columns, details, B Limited and also H Limited. The values are in thousands of shillings. The values are in thousands of shillings. Are in thousands of shillings. Sasa, like that. And let's assume, for example, in this question, we are also required to prepare the purchasing company account. So basically, no much interest we can be able to make in that account, because majorly what we record here is the purchase consideration. But let's also prepare that account. We see what we can record with in that account without necessarily or without having computed the purchase consideration. So what do we record in this account, which is called the purchasing company account? The purchasing company in our case is S Limited company account. And remember here, purchasing company is 1. So therefore, we are not preparing for B, we are not preparing for H. The purchasing company is what? Is S. Yes. Now, having that, I think what we need to do is basically remove and prepare this particular account. Let's proceed and prepare these accounts. And remember, we prepare this account basically to cross off the books of account of the two old companies. So what we do, just like what you have done in the other question, we go back to the balance sheet of these two companies. The balance sheet of these two companies, B and H, we start with crossing off the asset account. So we have a number of assets there. We just need to know which assets were taken over by the new company, which assets were being written off. So that information I can see it in note number 8. So we are told that tangible assets were taken over by S at the following fair values. The assets which were taken over include PP, current assets. Now, you can see, I think in the balance sheet, we have how many assets, PP, we have intangible asset, which is copyright, and then we have current asset. We must be given some information about intangible asset. What is happening to the intangible asset? Because intangible asset is not one of the assets which was taken over. Now, that information, we have it in note 7. In note 7, you're told the copyright of B, which is basically the intangible asset, expired upon amalgamation of the old companies and therefore was to be written off. So therefore, the copyright, which is the intangible asset, was to be written off. So therefore, starting from where we have the asset, the PPE of the two companies were transferred to the new company. So we need to debit them in this account at their book values. The book values or the carrying amounts, these are the values we have in the balance sheet. So the PP of B, 16,500, the PP of H, 12,000. So then from there we have the intangible asset. Intangible asset, this one was written off. So being an asset which was written off, we basically debited here intangible asset, and this is only for B, 84. This company didn't have intangible asset. Then from there we have current asset, and current asset we are given the total. As per note number 8, current assets were taken over by the new company. So being assets taken over, we debit that here, current assets, which is how much? 52,500. And basically how much? 30,000. That's basically what we have there. Then we go to equity section. In the equity section, we start with the ordinary share capital. So the ordinary share capital basically will be credited in this account here. Ordinary share capital. Ordinary share capital. Ordinary share capital for the first company is basically 30,000. For the other company is what? Is 16,000. Below that, we have preference share capital. Preference share capital is crossed off to this account. So we need to credit this account. 7.5% preference share capital for B. This one is 10,000. This one is what? 24,000. So then below that, what do we have? Share premium. All the reserves should be crossed off to this account. Basically, we credit that to this account. The share premium. The share premium for B is basically 16. The share premium for H is what? Is 1400. And then from there, we have the losses. Losses should be debited in this account. So we refer to them as accumulated losses. Accumulated losses, we have 23,400. And then we have 34,300. Sasa? Yes, I hope you're together up to that point. Then from there, we go to the liabilities. Liabilities, we have non-current liabilities and current liabilities. So what are we told about these both? What are we told about the liabilities? So I think in note number 6, we are told the current liabilities of the old company were transferred to the new company. The current liabilities were transferred to the new company. There is another information which is given in respect to the both, and that information is in note number 4. The information for both is given in note number 4. We are told the bondholders in both companies were settled by issue of by the new company issuing ordinary shares of shillings 10 each to satisfy the nominal value of the bond. So basically, the bonds which is non-current liabilities, this one was not transferred to the new company, but basically the bondholders were paid. And we said, if you can remember the question we did yesterday, we said that usually the bondholders or the debenture holders are paid their full amount. They do not suffer any loss. That's why we say there is no need of preparing an account which is called, for example, in this case, the bondholders, ordinary shareholders members account. So that is the bondholders sundry members account. There is no need of preparing that account because generally this account and this one, we prepare this to account to determine how much loss was covered by the ordinary shareholders and the preference shareholders. The bondholders were paid the full amount, so they didn't suffer any loss. Sasa? Yes. So therefore, we will not prepare that account. What we will account for there are the liabilities, the current liabilities. The current liabilities which were transferred to the new company, we do what? We credit them in this account. We start with the trade payables. The trade payables, we have 37,200 for B. For H is 18,400. Then below that, we have bank overdraft. We have the bank OD, which is 2,000. And basically what? 15. And what? 15. You can see we have crossed off all those particular accounts. Then we have said we must always remember to account for 2 additional items which will not be part of the balance sheet. One of it is the preference dividend in arrears, and number 2, the liquidation cost which was paid by the new company. I think we can first of all account for the liquidation cost. This one is in note number 9. I can see it in note number 9. We are told the liquidation expenses of B and H amounted to 8 million and 5 million respectively, and were paid by S Limited, and S Limited treated this as preliminary expenses. Yes. So the liquidation cost, which can also be known as the dissolution cost, paid by the new company, that one we have said should be debited in this account, and that is 8 million and basically 5 million. And then we have said that the entry for this is to credit this account, to credit the purchasing company account. So we have the liquidation cost. So the liquidation cost, you can show which the amount which was paid for B and the amount which was paid for H. Remember, I've said that this account will not be prepared for in columnar format. We have one purchasing company, that is S. So this one is 8 million, and this one is what? Is 5 million. So then from there, finally, we account for what? The preference dividend in what? In arrears. In all questions for external reconstruction, we come across this. So where do we have that information? We have it somewhere either within note 1, 2, 3, 4, or 5. There, somewhere there. So that information is given in note number 2. In note number 2, so the preference dividend in B were 3 years in arrears, while in H Limited, while H Limited preference dividend had not been paid for 2 years, including the current year. In other terms, the preference dividends for H were 2 years in arrears. For B, they were 3 years in arrears. How do we compute, or where do we get the information to compute the preference dividends in arrears? You don't need to go back to the balance sheet, just come to this account here. You'll be able to see that the preference shares issued by the 2 companies were 7.5. So meaning that the preference dividends which were in arrears for B, this company here would be 7.5% of the preference share capital 10,000, and you're told those dividends were in arrears for 3 years. The preference dividend in arrears for H will be 7.5% times The amount of preference share capital 24,000 times 2 years. The dividends for H were 2 years in arrears. Yes, so I'm told this one will be 2250. I hope that one is for B. I hope that one is for B. I hope that one is for B. Yes, that one is for B. What about the other company? That is H. H. Is it 36? That is 600. 36. That is 600, eh? That is 600. Yes, that is 600. So we need to account for those dividends here. So for B, 2250. For H, that is 6. So we debit this account and then we credit this, the preference dividend in arrears. So we have 2250, and basically that equals 36. So that part A, you rebate now at that point. You'll have scored all the marks. You'll have scored all the marks. You'll have scored all the marks because you can see the marks are located here. The marks are located here. Someone is saying my video is not clear. Maybe someone to confirm. Is my video clear? Please confirm. Yes, I'm told my video is clear, Fred. Check on what is happening on your side. Yes, so you can see the marks are located here are 4. So these are the items which will learn you the marks: 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Even if you are to be given a half, which is the minimum, you have the 4 marks there. So the marks given here are 4. 1, 2, 3, 4, 5, 6, 7. Remember, I said that in most of the cases, this account and this one, the entries are given 1 mark. 1 what? 1 mark. So, but even if, for example, you're given half, 1, 2, 3, 4, 5, 6, 7. So 7 times half is basically 3.5. This should be rounded off to 4. So this one, okay, yes, this one here, the marks are given are basically 4. Usually this one, I've said this one, for every correct entry here, the marks to be allocated will be 1 for every correct entry, because here we don't have so many entries. Yes. So you can see by doing that, you already have so many marks with you. And then from there, we need to move and basically answer part B. Part B, what are we required to do? Part B, we are required to make what? The journal entries. To do what? To open the books. To open the books of S Limited. To open the books of account of S Limited. And just like what you have done in the other question, we will basically account for 3 items only. The assets which were taken over, assets which were taken over at fair value, the liabilities which were taken over, and also the purchase consideration which was paid. And like in our question here, we are told no narration which are required, but let's just put some small explanation regarding what we are accounting for your revision purpose. We first of all account for the assets which were taken over. The assets which were taken over here at the fair value. So the assets which were taken over at the fair value, we have said that those assets should be debited in the respective asset account and then credited in what? Credited in the business purchase account. So the assets which were taken over, we have them in note number. We have them in note number 8. The assets which were taken over, the first asset is property, plant, and equipment. So remember this company, that is S Limited, took over assets from 2 companies. Took over asset of B, took over asset of H. But it's obvious that this company will open a single PP account. So the amount to be debited, that should be the total. Should be the total fair value of the assets which were taken over from the 2 companies. So the amount to be debited in this account will be the total fair value we have in note number 8. That is 12.5. And basically what? And 95. And 95, the total. Will that give us 22,000? Yes. So then from there we have the current assets. The current assets, we have 58 plus 38.6. That will give us a total what? That will give us a total of 96. 96, 600 there. 96, 600. Is that what you're getting? 96, 600. Yes, give me the total, give me the total, give me the total. So the total current assets. Yes, so 96, 600. Then there is something you have said we always need to check. The preliminary, the liquidation costs, which were paid by the new company on behalf of the old company, were they capitalized? Were they treated as preliminary expenses in the books of account of the new company? Yes. So that information, we have it in note number 9, that the liquidation expenses of B and H were 8 million and 5 million and were paid by S, and they were treated as preliminary expenses. They were capitalized. So we have 5 million plus 8 million, and basically that will give us 13 what? 13 million. These are the assets which were taken over, and then we credit the total in the account called the business purchase account. So what will be the total here? So this will be 131, 600, 131, 600. So total asset taken over. Then from there we can account for the liabilities, which were taken over. The liabilities which were taken over. The liabilities which were taken over, we have them from in the realization account. These two liabilities, the payables and the bank overdraft. So we have said we debit the total amount in the account called the business purchase, basically with the total, and then we credit the trade payables. The trade payables will be credited with the total amount here. That is basically 37,200 plus 18,400. And basically that will give us a total of 55,600. 55,600. And then we also credit the bank overdraft. The bank overdraft, we have 2,000 plus 15. And that will give us what? That will give us 35. So the total amount, which now will be 59,100, that one will be debited in the business purchase. Will be debited in the business purchase. Are those additions correct? Are the additions correct? Are those additions correct? Yes, they are. So then from there, we proceeded. Basically, we account for what? We account for the purchase consideration which was paid. Purchase consideration which was paid. Number 3, purchase consideration which was paid. So the purchase consideration which was paid, we have said that this one will be debited in the account which is called the selling company account, and then credited in what? Credited in the bank. We debit selling company. So selling company, we have 2 companies, that is B and basically what? H Limited. So the purchase consideration which was paid on behalf of B is 8. Record that separately here, and basically 5 million. And then the total amount, that one should be credited in the bank account. That is 13 what? 13 million. That is the purchase consideration which was paid. Oh, sorry. sorry. I think, no, that one should be liquidation, not the purchase. Sorry for that. The liquidation cost. I think Morimo is moving too fast. Thank you, Cyrus. Yes, that one should be the liquidation. That one should be what? The liquidation cost, not the purchase consideration. Sasa? Yes. So, do we have anything else maybe you can account for here? I think none. So, equally, you can leave that part B at that point. At that point, how many entries? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So, the marks are located at 4. Even if you're given a half by every correct entry, you already have all the marks with you. Sasa? Yes, even if you are to be given half marks per every correct entry, you'll have scored all the marks. You'll have scored all the marks. So these questions are very, very simple. If you happen to come across this question, should even start smiling. Even before start doing that question, should start smiling, because this is a question you should be able to get over 18 months. Over 18 months. So these are questions which is very, very good, simple. So we finalize by basically preparing the statement of financial position. Statement of financial position as at 1st of October 2018, as at 1st of October 2018. So equally, so many free marks are here. We start by recording the non-current assets. Non-current assets. Non-current assets. And in our case here, we have a number of non-current assets, starting with the assets which were taken over as per note number 8. And I think we have already made a journal entry for that. We'll start by recording the PP. And I think the PP have gotten the total, which is 22,000. So that will not change. So then from there, we have current asset. Current asset, we record that down here. But before we record the current asset, we record what? The preliminary expenses, the liquidation expenses which were paid by the new company, but basically capitalized. The total is 13. Is 13. Then from there, we have the current assets. The current assets. Current assets. The current asset. Current asset was a total amount of how much? Current asset was 100 and what? 1 what? Current assets. 96. 600. Yes. So then from there, we proceed and record the other items. Like I think for this particular question here, we can't be able to determine the share capital, because for us to compute the share capital, we have to go back and compute the purchase consideration. And like the other question which you have done, whereby we are told the company had issued all the shares, so which were not issued to pay the purchase consideration, there is no information which are given in relation to that in this question. So it automatically means that in this question here, we can't basically be able to determine the share capital of this company. We can't be able to determine the ordinary share capital. I think maybe what we can record here are only the current liabilities which were taken over. So equally, we don't have any non-current liability. I think we only have current. And it is obvious that this particular bank overdraft will have to be paid, because our company must raise some cash through the issue of the share. So I think what we'll have here is only one, that is the trade payables. Trade payables, and which should be the total, that is 7,200 plus 18,400 plus 18,400, and this will give us a total of 55,600. 55,600, is that what you're getting? Yes, 55,600. 55,600. 55,600. Is that what you're getting? 55,600. 55,600. Yes, and basically these now, I think, are the free entries which you get here. 1, 2, 3. 1, 2, 3, 4. Even if, for example, you're given half, you have to be given half. Assuming you have to be given half, you can see still you'll also be able to get 2 marks out of 4. Out of 4 marks, you'll be able to get, should be able to get 2 marks. Now, basically what I've said is that this question, if you happen to come across this particular question, make sure you do that question. You can start even with this question and make sure you get over 15 marks. You make sure you get over 15 what? Marks. Using that particular approach which I've shown you, you should be able to get more than 15 what? Marks. The other thing is that is a question to be done within even 30 minutes. 30 minutes you are done with that question, you get more than 15 marks, and basically you move to the other what? To the other questions there. Yes, Cyrus, in this question, we can't be able to conclude that the share capital of this company would be 120. Because if you can be able to recall the other question, which I've done, there were some shares which were issued to pay the purchase consideration, even in this question, but automatically some of the shares were not issued. You see the reason why the other question we have taken the share capital is equal to the registered share capital is because there was an information that those shares which were not issued to pay the purchase consideration, all of them were issued for cash. By the end of the day, that company had issued all the shares. In this question, do we have such information? In this question, we don't have such information that our company here issued the remaining shares, issued all the remaining shares for cash. That is the difference between the two questions. Sasa, that is the difference between the two what? Questions. Now, that is it. That basically how we account for this. But you can see this question is a question for merger. But is there any difference between how we account for merger and external reconstruction? You can see there is no much difference. No much difference at all. No much difference. Now, there was another question, although that one, there is a concept which was incorporated in that question. I don't know whether I can, yes, I can guide you. I think we have some few minutes. Let's go to this question here. The question for yes, the question for December of 2022. For 2022, yes, this one is quite simple. If you happen to come across this question, I'm saying you should always start smiling, because these are 3 months, very 3 months, and which you'll be able to earn within a very short period of time. Within a very short period of time, because as I mentioned yesterday, what makes this question to take a lot of time is the computation of purchase consideration. If you decide to compute the purchase consideration, you'll not be able to finish this particular question, and that purchase consideration will not even earn you a lot of marks, but it consumes a lot of your time. It consumes a lot of your time trying to compute that purchase what consideration. Can we go to this other question for December 2022? December 2022, and that is question 5. Question 5. Yes, question number 5. This one is a little bit different, but what happens is that in that question, there is a concept which the examiner has incorporated here on compound financial instruments. On compound financial instruments, you'll be able to see that some of these particular questions, in some instances, the examiner may try to test a different standard. Like this question, it was testing a concept on compound financial instrument, IFRS 9. So let's go through this question. We see what you're told. And you're told 𝐻𝐍 Limited, a private limited company, has been in financial difficulties and has reported trading losses for a number of years. The directors of the company invited the shareholders and the creditors for a special general meeting where it was resolved that the operation of 𝐻𝐍 Limited be transferred to a newly formed company, which is to be known as 𝐶𝐍 Limited, with effect from 1st of August 2022. So this company, which is called 𝐻𝐍, this company will be liquidated. So meaning that this is the old, in other terms, this is the selling company, and its business operation will be taken over by a new company, which is called what? Which is called 𝐶𝐍 Limited. So basically, this is the new or the purchasing company. Sasa, yes, that is the information which we have. And then from there, we have the statement of financial position of this company, which is called what? 𝐻𝐍. And then from there, we have additional information, number 1, all the way to note number 10. So then what are we required to do here? We are required to prepare the foreign ledger account to cross off the books of account of 𝐻𝐍. So no much problem with that. No much problem with that, because you just need to do what you have done in the other 2 questions. Now, what I want us to do is there is part B of that question. I think I will not do the entire part of it. Maybe I'll show you part of it, part B. So we are required to make the journal entries in the books of account of 𝐶𝐍 Limited to record the initial recognition of the 8% convertible bonds and the right issue on 1st of August 2022. Now, in this case here, the examiner, I think, tested 2 concepts here. Something to do with 8% convertible bonds. And remember, we say that if, for example, a company issue convertible debt instrument, what you need to remember very fast is that this is a compound financial instrument. And I hope you can be able to remember, we say that as per IFRS 32, anytime the company has issued a compound financial instrument, e.g. convertible bonds, we say the company should split the 2 components. the liability component, and the equity component. Now, that is what the examiner was testing here. You can see that is a totally different concept from the question itself, because that is a concept from a different word studied. And I think there was some information about what the right issue. Where do we have the information about 8% convertible bonds? Where do we have information about the right issue? I think we will start with the 8% convertible bonds. Convertible bonds. So where do we have this information about these bonds? This information is given somewhere in note number 5. Given in note number 5. Can we go to note number 5? In note number 5, we are told the bond holders in Tahidi Limited. Tahidi Limited, remember, is the old company. Can we go back to the balance sheet of Tahidi? We know that the bonds is part of the non-current liabilities. So this company here had issued 12% bonds. 12% bonds having a value of 12.5 million. So those are the bonds which were issued by the Tahidi. So let's go back to note 5. We are told that the bond holders in Tahidi Limited agreed to be transferred to the new company on the condition that the bonds would be converted into ordinary shares after 3 years. And then you're told the coupon interest rate for the convertible bonds were 8% per annum. And then you're told similar bonds with no conversion rights attracted an interest at the rate of 10%. And then you're told the accrued interest on the bonds were to be paid immediately. I think we can ignore that last statement. But basically what you're told is that these particular bonds, which were issued by this company, that is Tahidi, these 12% bonds, they were basically transferred to the new company. They were transferred to the new company. In other terms, they were taken over by the new company, but they were transferred on which condition? They were transferred to the new company on the condition that the bonds will be converted into ordinary shares after 3 years. It basically means that once these particular bonds were transferred to the new company, they became 12%. They became 12% convertible bonds. 12% convertible. Okay, I think the interest rate also changed, because if you check on the other sentence, we are told the coupon interest rate for the convertible bonds was to be 8%. So this one became 8% convertible bonds. Now, basically, even before you go to the other information, what you needed to remember here is that this is what is a compound financial instrument. These are concepts we covered in the topic of financial instrument. And actually, we say that anytime the company has issued a compound financial instrument, according to IAS 32, the company on initial recognition should split the liability component and the equity component. That's what you needed to do as per that point. So what we need to do is we split the two components. So remember, you say to split the two components, we follow 2 steps. Step 1 is basically to compute the liability component. We compute the liability component. And actually, we're going to compute the liability component on the dates they were transferred to the new company. So I hope you can be able to recall the transfer. Maybe we can go back to note number C in the requirement. What you have in part C, we are required to prepare the opening statement for financial position of the new company on 1st August. So it automatically means that all the assets and liabilities of the old company were transferred to the new company on this date, 1st of August 2022. 1st of August 2022. So what basically we need to do here is we compute the liability component. I hope you can be able to recall how we were computing the liability component for the compound financial instrument. We say that this one will be equal to the present value of the annual interest minus, that is plus, the present value of the principal amount. I hope you can be able to remember that formula. That is something we covered in the topic of financial instrument. So what we just need to do is to compute the annual interest. The interest will be paid annually. And we said the interest per annum, this one is equal to the, this one is equal to what? This one is equal to the coupon interest rate. Coupon interest rate. We multiply that with what? We multiply that with the nominal, the par, or basically the face value. So if you check the information which are given in that note number 5, you'll be able to see that we have 2 interest rates. We have this one, which is the coupon interest rate, and also we have another interest rate, which is 10%. 10% is the effective interest rate, which you use for discounting. So therefore, the interest to be paid by our company annually will be equal to 8% of the nominal or the par value. Remember, when these particular bonds were transferred to the new company, they were transferred at their fair value here. At their value, that is 12.5. So therefore, the interest to be paid annually will be that one, which will be 8% of 12.5. So let's work out this 8% of 12.5, and basically that will give us what? That will give us 1,000 per annum. And this interest, who can tell us it will be paid for the next how many years? Because there is some information we are given in note number 5. What is the life of these convertible bonds? Yes, their life is 3 years. Their life is 3 years because we are told they will be converted at the end of the 3rd year. This will be paid for the next 3 years. So that is basically the annual interest. What about the principal amount? In this case, we say the principal amount. This one is always equal to the par value, unless otherwise stated. Unless otherwise what? Unless otherwise stated. And there is no information which are given here about the amount to be paid on redemption. So the amount to be paid on redemption will be this one, will be the par value or the nominal value, which is this one, which is 12.5. That is the amount to be paid at the end of the 3rd year. So what we just need to do to discount those items, we first of all start by discounting the annual interest, this one, 1,000. So that one will be equal to 1,000. We multiply that with the present value interest factor of annuity, and we discount this using the effective interest rate, which is 10%. 10% for 3 years. And then we add this, we discount this, which is basically 12,500. We multiply that with the present value, interest factor at the rate of 10% for 3 years. Remember, this is an annuity, this is a lump sum. Yes. So the formula for discounting the two will be different. So we have 1,000. So the formula, this one is 1 minus 1 plus R, which is basically 1.1 raised to power negative 3 divided by 0.1. So what about this one? 12.5. This is a lump sum. This will be 1.1 raised to power negative 3. That is basically how we discount that. So what is the present value interest factor of annuity here? Is 1.1, which is raised to power negative 3. 1 minus answer divided by 0.1. Yes, times 1,000. Times 1,000. So in this case, I'm getting 24. 24 to the nearest whole number, 2487. To the nearest whole number, yes. So what about this one? 1.1 raised to power negative 3 times 12,500. So this one is 93, 91. So therefore, the liability component, the value of the liability component will be equal to the total, which is 24,87 plus 93, 91. So this one will give us 11,878. What is that? That is the liability component. Having computed the liability component, we say step 2 is to compute the equity what? To compute the equity component on the same date, 1st August over 2022. And actually we said to compute this, we take the sales what? The sales profit, or basically the amount which was received. In other terms, the sales profits, or basically the amount here, will be equal to the value, now, which was basically paid, which was paid, because now the holder of this particular bonds were paid this amount. Yes, were paid this amount, 12.5. Yes, so we take that minus the liability component. The liability component on the same date, which is what you have computed there, 18,787. So what do we get here as the equity component? The value of the equity component. The difference. So which is what? Which is 622. Now, what the examiner was requiring is you make the accounting entries, or you show the accounting entries or the journal entries on this date. That is 1st of August 2022. 22. So how will our company account for this? How will our company account for this? Yeah, remember this basically a liability which was taken over. So being a liability which was taken over, this one should be debited in which account? This one will basically be debited in the account which is called the business purchase account. Sasa, because it's a liability. So with the total amount 12.5, and then we credit two accounts. We are going to credit the first account which is called the liability component of the convertible, that is 8% convertible bonds with this particular amount. This is the liability component. And then we credit the other account, which is called what? The equity component of 8% convertible bonds with this particular amount there. So this is basically what was examined here, but you can see what the examiner here was testing is on the candidate's knowledge on IFRS 9 and also IS 32. So a concept which is totally different from the concept of what? The concept of reconstruction. I think for the right issue, we will not do it because of time. But essentially, what you need to do, can you do the other part? You do part A, and also you do what? You do part C. So I think that was the only tricky part, but basically that is the concept which was being what? Explained. Sasa? Yes. So that should bring us now to the end of that area of external reconstruction. And maybe we will see if we can get some time, because this is an area which I expect it may be tested. Maybe we are going to revisit it if we will get some more time. But make sure you attempt the two questions. This one you finish on it, and the other question for, I think, for December 2021, and you try to use that approach which I've shown you. Try to use that particular approach, and you see whether you can be able to do what Yes, now when preparing the statement of financial position of the new company, this one will appear at the equity. This one will appear at the equity in the statement of financial position. This one will appear at the non-current liabilities in the statement of financial position. Sasa? Yes. So that's how they will affect the statement of. Remember how if you go back to what we did in relation to this, you'll be able to see how you are recording this compound financial instrument. Sasa? Yes. So I want us to stop at that point for today. We continue from there on Saturday as we revise on something else. So can we start by revising still cash flows? Can we go back to cash flows before you forget that concept? Cash flows? Yes. So can you check on cash flows? Check on group cash flows. I think we will equally try to do like 3 questions using that shortcut. Using that shortcut, which basically we are using here. You revise on that. That is what you're going to revise on Saturday. Group statement of cash flows. Sasa? Yes. So we stop at that point for now. Have a good night. See you on Saturday.
pay their future.
One, with the values we have in the statement of financial position of the carrying amount, we determine whether you have a revaluation or actually an increase or decrease in the value of the asset. We start with the receivables. Receivables in the statement of financial position, its value is 72, but receivables will be revalued to 36. So meaning that for receivables, the value for receivables is reduced from 72 to 36. So we have a decrease of 36. From 72 to 36, that is a decrease of 36. The other asset is basically inventory, which is still part of the current asset. Its carrying amount is 4,000, but it will be revalued. It will be revalued. It will be revalued to an amount of how much? It will be revalued to an amount of what? To an amount of 64. Okay, sorry. I think we are interchanging. So the value for receivables is 4,000. It will be revalued to 36. So mean that we have a decrease of 400. A decrease of 400. So then we have inventory. Inventory will be revalued to 64. The carrying amount for inventory in the balance sheet is 72. So we have a decrease of what? A decrease of 800. A decrease of 800. A decrease of 800 from 72 to 64. Yes. So then from there we have machine. Machine, its carrying amount is how much? The carrying amount for machine is 28. It will be revalued to 2,000. So we have a decrease of 800. We have a decrease of 800. And then buildings, it will be revalued to 5,000. From 6,000, we equally have a decrease of what? Of 1,000. A decrease of what? Of 1,000. Sasa, yes, in that case, I've said both depreciations which are given there, we ignore them. I've said you cannot revalue an asset today and you depreciate the asset at the same time. So you revalue, then depreciate the asset at the end of the year. So therefore, we ignore those depreciations. So basically, it means that the value for all those assets, receivables, inventory, machine, building, their value reduces. How do we account for that decrease in the value of the asset? We said once the assets have been revalued and their value reduces, we need to credit the specific assets account in order to reduce its value. We complete the double entry by debiting the account called the capital reduction account. So therefore, the first general entry here is basically to account for the revaluation of those assets. To account for the revaluation of those assets. So if you check those values, they are basically in thousands of shillings. Okay, so when making the general entry, let's have the debit column here and basically the credit column. So we always start with the account to be debited. That's basically what we know. The account to be debited is the capital reduction account. And this account will be debited with the total decrease, or actually with the decrease, the total decrease in value for all the assets. We have 400, 800, 800, and 1,000. That will give us a total decrease of how much? That should be 12, 2,000, 3,000. Are you getting a total decrease in the value of assets to be 3,000? To be 3,000. We try to vary because of time, yes. So then we debit that account, capital reduction account, and then we credit a number of assets. Which account are we crediting? First of all, we credit the receivables account. The receivables account is an amount of 400. We also credit the inventory account. The inventories account is an amount of 800. We credit the machinery account with an amount of 800. We also credit the buildings account. The buildings account with an amount of what? With an amount of 1,000. With an amount of what? Of 1,000. And then in this case, we said, make sure you give a brief narration. The narration will be being a revaluation of assets. being a revaluation of who? Of assets. Being a revaluation of assets. So we have accounted for the revaluation of assets. Let's move to note number 2. In note number 2, we are told its ordinary share is to be redesignated as a share of 2.5. And then you're told the ordinary shareholders are to accept a reduction in the nominal value of their shares from 10 shillings to 2.5. In addition, the shareholders are to subscribe for a new issue on the basis of 1 share for every 2 shares held at a price of 4. Now, 2 things there. Number 1, we need to account for the decrease in the value of the assets, because we are told the shareholders will accept a decrease in the value of the share from 10 shillings all the way to 2.5. In this case, what we need to account for here is the amount of share capital, which automatically was written off. So the amount of share capital written off, first of all, we determine the amount which was written off per share. If the company is reducing the par value of the share from 10 to 2.5, it basically means that part of the par value has been written off. The amount written off is that decrease. So the value of the share is reducing with how much? Is reducing from 10 to 2.5. The value of the share, therefore, is reducing with 7.5. We multiply that with the shares issued by this company. And in this case, I hope you can see that information note number 2 deals with the ordinary shares. So we go back to the balance sheet of this company, specifically at the equity. That's where we get the shares issued. So how many shares were issued by this company? We take the equity share capital or the ordinary share capital, which is 20,000. Remember, these are not shares. This is the share capital. How do we get the number of shares? We divide that with the par value, which is still in the balance sheet at the equity. I hope you can see the word equity shares of shillings 10 par value. So therefore, the shares issued by this company are 2,000. We multiply that with 7.5. And that basically will give us what? That will give us what? Will that give us 15,000? 15,000, the amount of share capital which is written off. The amount of share capital which is written off. Yes. So how do we account for that? How do we account for this? Remember, we say, in case we want to reduce the share capital, remember share capital has a credit balance. So if we want to reduce this, we debit that account. We debit share capital. We complete the double entry using the capital reduction account. So therefore, in this case, we will debit the equity share capital account. Equity share capital account with the amount which was written off, 15,000. And then we complete the double entry by crediting the capital reduction account with the same amount of 15,000. The same amount of 15,000. What is our narration here? Our narration is being the share capital, which is written off. So what we have accounted for here is the share capital which is written off, being the share capital written off, being the share capital written off. So in the same point, number two, we are told, other than the company writing off the value of each share, we are told that existing shareholders of the company will subscribe. To subscribe is to buy. If you buy shares of the company, you pay for those shares. So in this case, we are told they have to subscribe. They have to buy a new or basically new shares on the basis of 1 share. So these are the new shares to be issued. New shares to be issued. And basically I've said that these are shares to be issued in cash. The existing shareholders will buy some shares. So they are to subscribe new shares on the basis of 1 share, on the basis of 1 share for every what? For every 2 shares which are held, for every 2 shares which are held. Now, how many ordinary shares are currently held? From what you have done up here, how many shares are currently held by the existing shareholders? The shares currently held, yes, we have said are 2,000. So these are the shares which are currently held. So we just cross multiply, then we divide, so that we determine how many shares are currently held. Sorry, how many shares will be issued, not held. So the shares to be issued will be 1 times 2,000 divided by 2, and basically this will give us 1,000 shares. 1,000 shares, and then we are told each share will be issued at 4 bob. Each share will be issued at an amount of 4 shillings. So meaning that the amount of money the company received here would be 4,000. Will be 4,000. So how do we account for this particular amount received by the company? How do we account for that amount received? Number 1, because this money was received, the shareholders paid for that money, we debit the bank account. Remember this money received, we debit bank, and then the company issued shares. So we credit the equity share capital account. Remember, the amount credited to be credited in this account always has to be based on the par value. Now, what is the new par value per share? What is the new par value per share here? What is the new par value per share? The new par value per share ni ngapi? The new par value per share is 2.5. Remember, it was previously 10. It has been reduced to 2.5. So therefore, the amount to be credited in this account will be based on the par value 2.5 times the shares issued. The shares issued were 1,000. So the amount credited in this account is 2.5. Now, it automatically means that because the shares were issued at 4 bob, the shares were issued at a premium, at a share premium. We say whenever we are accounting for external reconstruction and shares have been issued at a share premium, that share premium is not taken to the share premium account, but rather we credit it in the capital reduction account. Sasa, yes, that amount we will not credit it in the share premium account, but basically we credit it in which account? The capital reduction account. And automatically that should be the difference here. That should be the difference 15. So we give a brief narration being issue of additional shares, or maybe being issue of shares for cash. So we are done with that. Let's move to point number 3. We are told the existing preference shareholders are to be exchanged for a new issue of 6 million, 15% preference shares of shillings 10 each, and 800,000 ordinary shares of shillings 2.5. So it basically means that if we go back to the balance sheet of this company, specifically at the equity, you'll see this company had issued 12%, not 12%, rather 10% preference shares. So the preference shares issued by this company, they have a value of 8,000. So we are told the holders of these particular shares will be required to surrender them back to the company. In exchange of what? In exchange of 6 million. In exchange of 6 million preference shares having a value of 10, and 800,000 ordinary shares, each share having a value of 2.5. Yes, and I think usually this question, there is a small typing error. So this particular amount here, you see this amount here, 6 million, that's 6 million, that should be shillings. Because you can see that these preference shares currently issued by the company, they have a value of 8 million. So automatically, once they are required to surrender them back to the company, they are required to surrender these shares back to the company. They must be issued with other shares or even debentures having the same value, value. So if you take 6 million times 10, because you can see, take into account we don't have the word shillings before 6 million. We can only take 6 million to be the shares. So you should take the share 6 million times 10. That will give us 60 million. You can see that one is more than that. So that's why I'm saying there was a small typing error. This one should be shillings. If you have the physical paper, so before the word 6 million, we should have 6 million. The issue of 6 million, 15% preference shares of shillings 10, and 800,000 2.5, or ordinary shares of 2.5, such that if you work out this now, 6 million, and then these ordinary shares which were issued 800 times 2.5. So if you multiply these two, this will give us what? Is it 2,000? 800,000 times 2.5. Is it 2,000? Yes, it should be 2,000. Such that if you add this and that should give us 8,000. So these preference shares which were issued and these ordinary shares which were issued, they must be having the same value, because the old preference shares which have been issued are to be exchanged with the new shares. Yes, so that's why I said there was a small typing error as far as that question is concerned. Now, what we need to do here is, number one, we cancel these shares. How do we cancel them? We cancel them. Remember, this account has a credit balance. So to cancel this, we will debit this account, and then we go ahead and basically debit to account. We debit this account for the new preference shares which were issued, and also we credit. That is to credit that account, and also we credit ordinary share capital. So we debit the 10% preference share capital, and then we credit to account. So we are cancelling the old shares and accounting for the new shares which were issued. So we debit the 10% preference share capital account with an amount of 8 million, or basically 8,000, and then we credit these preference shares which were issued. They were 15%. We credit 15% preference shares, preference share capital account with 6 million, and then we credit equity share capital with an amount of 2,000. With an amount of 2,000. Yes. So what is the narration? Being the old preference shares which were cancelled. Being the old preference shares which were cancelled. Yes, and I think we are done with that particular point. Let's move to point number 4. Let's move to point number 4. In point number 4, what are we told? We are told that the debenture holders are to accept 200,000 ordinary shares of shillings 2.5 each in lieu of interest payable. Then you're told the 12% debentures are to be converted to 14% debentures. And then you're told a further shillings 2 million or 14% debentures of shillings 10 each are to be issued and taken up by the existing debenture holders at 90 shillings per debenture. So in that case, I think we have like 3 transactions we need to account for. Number 1, let's account for what we have in the first sentence. We are told the debenture holders are to accept 200,000 ordinary shares of shillings 2.5 in lieu of the interest payable. It basically means that the interest which was supposed to be paid to the debenture holders was in arrears. So instead of the debenture holders being paid that interest which was in arrears, instead of being paid that interest in cash, they will be issued with the ordinary share of the company as a form of a payment. So first of all, we need to determine how much was this interest, or how much was the interest in arrears. That one is in the balance sheet of the company below paragraph 1 and specifically under equity. Can you be able to see the interest payable on debentures, or the interest payable to the debenture holders under equity? Under equity, yeah, that one should be 720, not 2,000. Should be 720. So basically, what we need to do, remember that is a liability. So being a liability, we are told this amount automatically will be paid. How will it be paid? It will be paid by the company issuing shares. So we need to first of all cross off this account. Because the liability has a credit balance, how do we cross that account? We debit that account. So the journal entry number 5 is to debit that account. We debit the account called interest payable on debentures with an amount of how much? 720. And then the debenture holders here will be paid by being issued with the shares. So how many shares will be issued to the debenture holders? The debenture holders in that case, we are told as per note number 4, they will be issued with 200,000 ordinary shares over 2.5. Of 2.5. Automatically, if you multiply these two, that one will give us 500,000. 500,000. So what happens, or what is the difference now here? You can see the amount which was to be paid 720, but the shares issued, they had a par value of 500. What happens to the difference? And remember, the amount to be debited has to be equal to the amount to be credited. Yes, the difference is the share premium. Do we take it to the share premium account? No. So we have said any share premium, any shares which are issued at a premium, any share premium is taken to the capital reduction account. So the difference here, which is 220, is the share premium. But do we credit it in the share premium account? No. We credit it in the account called the capital reduction account. Capital reduction account. So we can say in the narration, being payment of accrued interest. Being payment of accrued interest. So still in the same point, we are basically done with that. Still in the same point, sentence 2, we are told that the 12% debentures are to be converted to 14% debentures, just like what we have done here. So what we need to do is we need to cross off the 12% debentures account. If we go back to the balance sheet of the company here, under equity, you'll be able to see that our company had issued 12% debentures. 12% debentures. We are given their value. We know debentures is a liability. So this account should have a credit balance. So these debentures are to be exchanged, to be converted, that is, to 14% debentures. What does that mean? It basically means that we need to cross off that account by debiting it, and then we open another account called 14% debentures. So this account, we credit it with the same amount. So we debit the 12% debentures basically to cross off that account, and then we credit the 14% debentures account. So what is the value of these 12% debentures from the balance sheet of our company? The 12% debentures, they had a value of 6,000. So in other terms, we have converted the 12% debentures into 14% debentures. So narration, being conversion of 12% debentures into 14% debentures. Being conversion of debentures, or you can just put it like that. Remember that narration has no mark, but it's always good to give a narration of what you have accounted for. Sasa, yes. In the same point, we also have other debentures which were issued in cash. In the last sentence, a further shillings 2 million 14% debentures of shillings 100 are to be issued and taken up by the existing debenture holders at 90 bob. So these are new debentures to be issued. The 14% debentures, we are told having a value of 2 million, having a value of 2 million, but in this case, we are told their par value is 100, but basically they will be issued at a discount. They'll be issued at a discount because we are told they will be issued at 90 bob. So basically what that means is that our company here, instead of receiving 2 million, the cash to be received, the cash received will be what? Will be 90 all over 100 times what? Times 2 million. In other terms, because they have a value of 100, but they will be issued at 90, it's like they were issued at a discount of 10%. Sasa? Yes. So the amount to be received should be equal to what? Should be equal to 90%. Because they were issued at a discount of 10, the company received 90% of 2 million, which is 1.8. 1.8. So that is basically the amount to be received. How do we account for this amount received? The amount received, number one, this one will be debited in the bank account. We debit the bank 18 with the cash which was received. With the cash which was received. Now, the difference which is, or actually the discount which is 200,000, which is the discount, that one, basically we take it to which account? We take it to the capital reduction account. We must account for that discount. So that discount is 200,000. We take it to the capital reduction account because by the end of the day, the amount to be credited in this account, the amount to be credited in the 14% debentures, 14% debentures, just like what you have said in relation to the shares, that one has to be based on the par value. Remember, the par value is 100. So the amount to be credited in this account has to be based on the par value of 100. So meaning that the amount to be credited in this account should be 2,000. It has to be based on the par value, just like the shares, So the narration being an issue of debentures for what? For cash. Being issue of debentures for cash. We are basically done with that. So let's move to the other point, number 5. In note number 5, we are told shillings 800,000 of the loan from directors is cancelled, and then you're told the balance of the loan is to be settled by the issue of 200,000 shares of shillings 2.5. So first of all, can we go back to the balance sheet of this company? We check how much was the loan from the directors. The loan from directors, that has to be either below as a liability, basically. The loan from the directors is a liability. Yes, and I can see that that one is given together with the share capital. So the loan from directors is basically 2,000. So what we are told in note number, let's go back to note number 5. We are told 800,000 of this shillings 800,000 will be cancelled. In other terms, it will be written off, whereas the balance is to be settled by issue of shares. So the balance will be settled by issue of shares. So how do we account for that basically? Remember, this account loan from directors is a liability account. So being a liability account, the account has a credit balance. So part of this amount is to be written off. We debit it here. The amount written off, we debit it in that account. Then the balance, which is basically 1200, this one will be settled by the company by issuing shares. By issuing what? Shares. So therefore, we make a journal entry for that. So we debit this account, loan from directors. First of all, let's account for this amount which was written off. Loan from directors. Loan from who? Directors. We debit that account with 800,000. So automatically the other entry will be in which account? Will be in the capital reduction. No, let's do this. This account basically we debit it with the total amount, because the full amount will be written off. Will be written off. But now when accounting for this amount which was written off, remember this amount will be debited in this account and then credited in which account? And that amount which was written off will be credited in the account called the capital reduction. This is the amount which was written off, the loan which was written off. It will basically be debited here, credited in which account? Capital reduction. Then this amount which was paid through the issue of shares, I hope you can see the number of shares which were to be issued to the directors. The directors were to be issued with how many shares? Are we given the number of shares which were to be issued to the directors? Yes, the directors were to be issued with 200,000 shares. 200,000 shares, each share having a value of 2.5. So if you multiply these 200 times that basically will give us 500. But you can see the amount which was to be paid by the company through the issue of shares, Ningapi, the amount which was to be paid through the issue of shares was 1,200. It also means that these particular shares which were issued to the directors were issued at a premium. Is that the position? Are they issued at a premium? Yes, because you can see the amount which was to be paid was 12, but the par value of those shares is 500. So therefore, what will be the double entry for that? We will credit the equity share capital with the shares which were issued, which are 200 times 2.5. 2.5, basically that will give us 500. So the difference between 500 and 12 will be a share premium. Where do we take the share premium? To the capital reduction account. To the capital reduction account. Remember, that is the share premium. That is the share what? The share premium on the shares which were issued. So by the end of the day, if you add this, the amount to be credited, the amount to be what? The amount which has been debited, you'll be able to see the amount is the same. So 800 plus the 500, which is 13, plus 700, 2,000, which is equal to that. So this is our narration being director's loan, which was cancelled, director's loan cancelled and paid. So we have accounted for the director's loan which was cancelled and the one which was paid. We are basically done with that. So then let's move to the other point, number 6, and I hope you're together up to that point. I hope you're together up to that point. Are we together up to that point? Can we move to point number 6? Yes, we are together up to that point. So in point number 6, you are told the investment are to be sold at their current market value of 6 million. So which are these particular investment? Investment automatically should be an asset. So if we go back to the balance sheet of this company, below the non-current assets, I can see we have intangible assets. One of the intangible assets is investment. The value for investment is 45. So we are told that investment, as per note number 6, we are told that investment will be sold at the current market value of 6 million. So the investment will be sold at a profit, because if you take the carrying amount of that investment is 45, but the investment will be sold at 6,000. So that profit, that gain on the sale of investment, that one automatically we cross it off, we take it to the capital reduction account. So first of all, we account for the amount which was received. The amount received, that one is debited in the bank. So how much amount was received? It should be equal to the sales proceeds. Sales proceeds is what we have in note number 6. Our investment was sold at 6 million. That is what we debit in the bank. That is what we debit in bank. And then the amount which we credit in the investment account should be equal to the carrying amount. Investment was recorded at 4.5. We credit that account with 4.5. The difference, which is basically 15, we are saying is the gain on the sale of investment. So that gain on sale of investment, where do we take it? We take it to the capital reduction account. To the capital reduction what? Account. So the narration here is being what? Being investment sold. Being investment which was sold. Being investment which was sold. Being investment which was sold. We are basically done with that. Let's move to point number 7. You're told bank overdraft was paid in full. Also very simple. Bank overdraft, we know, is a liability. Is a liability. So if bank overdraft was paid and is a liability, we need to cross off this account by debiting that. We debit that account, we credit bank account. So we debit bank overdraft account. Bank overdraft, this one has to be part of the current liabilities in our balance sheet. And the bank overdraft is basically 3,000. And then we credit bank account with an amount of 3,000. So the narration here is being payment of bank OD. 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 Yes. So we are done with that point. Let's move to point number 8. And we are told the sum of 3.18 million is to be paid off. Is to be paid to offset the sundry payables immediately, and the balance in 4 equal installments at the end of each quarter. So I think in our case here, what we need to do is to account for the amount of payables which was paid, or the amount of sundry payables which was paid. So that one is basically quite simple, because what you just need to do is to, once a liability has been paid, we debit the liability account. So we will debit the payables account, or actually the sundry payables, which is basically part of the current liabilities. Sundry payables with the amount which was paid as per note number 8, that 180, and then automatically we do what? We credit bank. We credit bank. I hope you can be able to see down there. That one what? That 180. That one what? 80. That 180. Then we need to give a brief narration for that. We need to give a brief narration for that. A brief narration for that. So being payment, or being partial payment, to who? To creditors. Being partial payment to creditors. Being partial payment to creditors. Being partial payment to creditors. Yes. So we are done with that, basically. And then we are told the balance will be paid in 4 equal installments. Are we interested with the amount to be paid in the remaining amount to be paid? No, because if you check on what you're told in part B, we are required to prepare the balance sheet of this company immediately after effecting this. So not even after a quarter, not even after a day, immediately after the company effected this. So we are not interested with the amount to be paid in the those quarters. Yes, we are not interested with that. Then number 9, we are told all intangible assets are to be eliminated. Being eliminated means that all the intangible assets will be written off. Will be written what? Will be written off. So I need to create some space here. Yes, so all the intangible assets will be written off. Which are those intangible assets? Automatically, it is all the intangible assets excluding investment. Remember, investment was sold. So we need to write off goodwill and patent and trademark. So how do we write off assets? So basically, we credit the asset account, because assets have a debit balance. We credit the asset account. We debit the capital reduction. We debit the capital what? The capital reduction. So this should be journal entry number 12. We debit capital reduction account. Capital reduction account. Capital reduction account with the total value for the 2 assets. Goodwill 6,000. Patent and trademark 500. That will give us a total of 65. And then which account do we credit? We credit goodwill. with an amount of 6,000. We credit patents and trademarks with an amount of what? With an amount of 500. Narration being intangible assets, which were written off, or maybe which were eliminated. Being intangible assets which were written off, or being intangible assets which were eliminated. Yes. So we are done with that. Then note number 10, we are told it is estimated that under the new arrangement, yes, now that information which we have in note number 10, that one will be used in answering part C. Do we use that in making the journal entries? No. That one will be used in answering part C of the question. So we are basically done, but there is something here we must always remember to account for, even if that information is not provided by the examiner. Remember, this company is trying to clean its books of accounts. Whenever the company is doing internal reconstruction, the company has to write off any accumulated losses. Even if that information is not given to you by the examiner, you must remember to account for that. You must write off the accumulated losses. So if you go back to the balance sheet of our company, specifically at the equity, you'll be able to see that the company had accumulated losses of 5.8. That accumulated losses has to be written off because the company cannot do internal restructuring and still the books of account remain with accumulated losses. That has to be written off. So how do we write off these accumulated losses? So remember, this account always has a debit balance. It is the retained earnings account which has a debit balance because those are losses. How do we write off that account? We credit it and then we debit the capital. We debit the capital reduction. We debit capital reduction account with accumulated losses of 58. And then we do what? We credit. We basically credit the accumulated losses account. Accumulated losses account with the 58. So what is the narration here? Narration is being accumulated losses. Being accumulated losses which were written off. Being accumulated losses which were written off. And I think in our case, basically we have done with preparing what was required. So in part A, that basically what was required. So by doing this, the marks are allocated here. The 10 allocated what? 10 allocated marks. Now, if you can be able to recall the other question which we did in class, after this, the examiner basically was requiring us to prepare the capital reduction account. Even though it is not a requirement in this question, can we prepare the capital reduction account? Let's prepare the capital reduction account, even though it is not a requirement here. Even though it is not what? A requirement. So let's prepare that account. I want to create some space here. So, but basically we have to remember here, our capital reduction will be debited with a total of 3,000. Yes. So let me create some space here. So we prepare the capital reduction account. Capital reduction. Capital reduction account. Capital reduction account. Yes. So, and our figures are in thousands of shillings. Are in thousands of shillings like that. Yes. So we have said as per the first journal entry, basically we said you need to go through all your journal entries, journal entry number 1 up to journal entry number 13 as you check what is affecting the capital reduction. Journal entry number 1, our capital reduction account is to be debited. Is to be debited with various items. So the first entry comes from the account called the trade receivables with an amount of 400. The other entry is in the inventories account with an amount of 800. The other entry is in machinery account with an amount of 800. And basically the other entry is in buildings account with an amount of how much? With an amount of 1,000. So that those particular amounts are basically what? Are debited in this account and then credited in the respective account. In the respective what? In the respective account. In the respective what? Account. Then we go to the journal entry number 2. We check whether the capital reduction account is affected. Yes, capital reduction account, you can see, it's supposed to be credited. The other entry, so this account we credit this. So the other entry is in equity share capital account with this particular amount, 15,000. Journal entry number 3, Is the capital reduction account affected? Yes, capital reduction account is to be credited with 15. So the other entry is in bank. Is in bank. That also affects capital reduction. Does this affect the capital reduction? No. General entry number 5. Is the capital reduction being affected? Yes. Capital reduction account is to be credited. The debit entry is in the interest payable. Payable on debentures, which is 220. So then this general entry capital reduction is not affected. Here capital reduction is to be debited. The other entry is this account is to be debited. The other entry is in 14% debentures with an amount of 200. I can do away with this basically. Yes, so then from there we have the other general entry here. This one. So the capital reduction account will be actually credited with a total amount of 800 and basically 700. I think we can combine that here. So that will be a total of 1500 to be credited. This account will be credited. The other entry is in the account called loans from directors with a total of 1500. That plus that, which will give us 15. So then from there, general entry number 9. So the capital reduction account is supposed to be credited with 1500. So the other entry is in bank account. Bank account. General entry number 10. General entry number 10 here. Capital reduction account is not affected. General entry number 11. Capital reduction is not affected. General entry number 12. Capital reduction is supposed to be debited. One of the entry is in goodwill account with an amount of 6,000. The other one is in patent and basically trademark 500. And then finally, general entry number 13, capital reduction account will be debited with an amount of 58. So the other entry is in the account called what? The accumulated losses account. And basically we are done. We are done. So remember you say that this account should either automatically balance or should either balance off, or we have a balancing figure on this side, which is called the capital reserves. The account should either balance off, or basically have a balancing figure on the debit side, which is known as the capital reserves. Yes. So can we do that? Can we determine whether our account is balancing, or basically we have what? We have a debit balance. That is basically what I'm getting on the credit. Yes, that is basically the figure I'm getting. Yes, so that is also what I'm getting from Ismail. Is that what you have? A balancing figure on the debit side. A balancing figure on the debit side, which is called what? The capital reserve. Is that what you have? Is that what you have? I hope that is what you have. I hope that is what you have. I hope that is what you're getting. Yes. Yes. So basically that is it. What we need to do is we basically move and prepare what is required in part B. What is required in part B? What is required in part B? What is required in part B? In part B, I think maybe first of all I can give you a small breather and then we come back having a lot of energy. We finish on what is remaining. So let's just take a small breather. We come back at 9:25. We continue. So a small breather, then we come back. Yes. So I want us to continue. Let's continue. Let's continue. I hope you're back. I hope you are back. Yes. So let's continue. I want us to go straight to preparing what is required in part B of the question. And basically, the examiner was requiring we prepare statements of financial position immediately after the internal reconstruction. Statement of financial position. This is as at 1st November 2021. 1st November 2021. So we just need to have a single column here, and we start with the non-current assets. So the non-current assets, we start with basically what you need to do when preparing this you should be guided by the original statement of financial position. In the original statement of financial position, we have land, buildings, machinery, intangible assets. So number one, we know that land was not revalued. The value for land remained the same. Land was not revalued, and basically its value was 8,000. Then below that we have buildings. Buildings, we record the value which we have in note number one. Buildings. We have, someone is asking, we go back to the general entries. Let's first of all finish this one. Then maybe I'll see. So buildings was basically valued as per note number one, and basically the value for buildings is 5,000. Is 5,000. 5,000. Yes. So then still in our statement of financial position, below buildings we have machinery. So basically machinery were valued as per note number one, and the value for machinery is basically 2,000. 2,000. So then below machinery, I've said we are using the original statement of financial position. So below machinery, what do we have? Intangible asset. We know investment was sold. Will it appear here? No. We know goodwill and basically patent and trademark were written off. They will not still appear here. So mean that all those particular intangible assets will not appear there. So then from there, we move and basically record the current assets. So for current assets, we start with, basically we have two current assets. Actually three current assets in our statement of financial position. We have the first one, which is inventories. Inventories were valued as per note number one to an amount of 64. We record inventory here at 64. Then also we have receivables. Receivables were valued as per note number one to a value to an amount of 36. Still in our statement of financial position, we have cash. This will not change. Because all the other amounts which were received by the company, we have assumed they were received through bank, or any payment which was made by the company, we have assumed it was made through bank. Automatically here, we will have to prepare the bank account and basically determine what is the bank balance, because there is automatically money which remains in the bank balance. And actually, instead of preparing the account, we can have that working here directly, because we know what was received, what was paid. So I think we just need to go through journal entries number one. There was no any amount there was nothing affecting bank in journal entry number one. Journal entry number two, there were those particular shares which were issued for cash. The shares which were issued for cash, they had a value of how much? Just go to the shares which were issued for cash and you give me that amount. We try to vary because of time. Was it 4,000? Was it 4,000? 4,000? Yes, 4,000. 4,000. So this is basically money received. So we will take all the money received as positive, any payment as a negative. So we have the amount which was received as per note number two. Note number three, no cash which was received. Note number four, we have the amount which was received from the issue of debentures, and that amount was 1,800. The amount received from the issue of debentures, is it 1,800? Yes, 1,800. Amount received from the issue of debentures. As per note number 4, please confirm. I can remember it was 1,800, the amount received from the issue of debentures. Then from there we have note number 6, the investment which was sold at 6 million. So this is the cash received, 6,000. Then we have note number 7, we have payment of an overdraft, that is minus. The overdraft was 3,000. The overdraft was 3,000. Then we also have note number 8, the payment to the creditors, that 180, which is still a negative. That 180 is a payment. Yes, I don't think we have anything else. That should give us the bank balance. The bank balance, I hope that is the figure I'm getting from Patrice, of 5620. Because the total amount received should be 10,000 plus 18, that is 11,800 minus 6180. Yes, so that one should give us what? Should give us 5620. Yes, I don't think we have any other asset here. And basically, we say no need of even getting these totals. We say these totals are not marked. So just move and you record equity. So for equity, we will also be guided by our original statement of financial position. So first of all, we have equity share capital. Equity share capital. We know this equity share capital will change. So the original share capital is basically 20. Instead of preparing the ledger account, let's just do the adjustment here. So then we go to the notes, and basically whatever is affecting share capital, we adjust it here. Ordinary share capital. So we have note number 1 is not affecting this. Note number 2, we have the amount of share capital which was written off. The share capital written off reduces this. So the share capital written off, I can remember, was 15,000. This is the share capital written off. We deducted from 20,000. Then we also have the shares which were issued as per note number 1 in cash. And whatever we add here is the par value. Out of the shares which were issued for cash, the par value for those shares is 25. Is that the position? The amount credited in the share capital? For your case, you can check that from the journal entries. You can check that from the journal entries you have. You check what is affecting ordinary share capital. That's that? Yes. So if it is a debit, it is to deduct that amount here. If it is a credit, is to add. So then accounting or actually number 2, we have an amount of 15,000 written off, and the shares which were issued at 25. Then note number 3, we have the shares which were issued, whose value is 2,000. We add 2,000. So then journal entry number 4, do we have shares which were issued there? Yes, the shares which were issued in lieu of interest, and basically they were 2,200 times 2.5. Basically, which will give us what? 500. Yes, what about journal entry number 5? So we have the loan paid to the directors. Yes, we have the shares which were issued to the directors. The shares were 200 times 2.5, and I think that will also give us 500. I hope that is still correct. Yes, and then we have note number 6, 7, 8, 9. I don't think we have any other transaction affecting ordinary share capital. What should be the final figure for the ordinary share capital? That should be 575, 45, 55. Is that the position? Yes. So this is 5,000, 75, 95, 10,000, 10,500. 10,500. Yes. So then from there we have this capital reserve. This capital reserve, we have it here as a component of reserve, capital reserve, which is basically an amount of 4220 capital reserves. Then we still go back to our original balance sheet and we check what else to be included here. We have 10% preference shares. Those 10% preference shares, I hope you can remember, they were cancelled as per the information we have in note number 3. They were exchanged with 15% preference shares. So here we will have 15% preference shares, or basically 15% preference share capital. So the preference shares, as per note number 3, basically will be having a value of 6 million. A value of 6 million. value of 6 million, 15% preference shares. Yes. So then from there, we go back to our original balance sheet. We have debentures. I think those debentures, we can now classify them as non-current liabilities. So then from there, still at the original balance sheet, we have interest payable on debentures. Will that appear here automatically? No, because I hope you can remember that amount was paid. The loan from directors will not appear here. It was part of it was written off, part of it was cancelled. The accumulated losses still will not appear here. So all those items will not appear here. So then from there we can move and basically we record non-current liabilities. Now for the non-current liabilities, we will have debentures, but I hope equally you can also be able to recall those debentures, 12% debentures in our original balance sheet. As per note number 4, they were converted to 14% debentures. Now we have 14% debentures. So the value for 14% debentures, one, this 12% debentures, they were converted into 14% debentures. So what was the value of those 12% debentures? The value for 12% debentures is how much? Is basically 6,000. But also remember, as per note number 4, there were other debentures which were issued by the company having a value of 2,000. So in total, the 14% debentures will be having a value of 8,000. A value of 8,000. The ones which were issued in exchange of the old debentures and the ones which were issued for cash. Sasa, yes. So then from there, do we have any other non-current liability which will appear here? Any other non-current liability which will appear here? I don't think so. Finally, I think what we have now are the current liabilities. So in that statement of financial position which we have here, we have bank overdraft. Automatically that will not appear here because it was paid. Then we have sundry payables. Sundry payables was supposed to be paid 51.80, but remember there was part of the amount which was paid to them as per note number 8. They were paid 31.80. So the amount which they were to be paid, or the balance was how much? Was 2,000. I think basically that's what we have. I don't think we have anything else. Yes. And automatically, once you balance out your statement of financial position, it should balance, but no need of getting those totals. No need of getting the totals. What basically will be marked are these entries. These are the entries which are marked. These are the entries which will give you the marks. These entries there, not the totals there. These are the entries. The entries which are marked. Basically, the marks allocated there were 8. Now, I want us to finalize with the last part. Let's do the last part of the question. This is a very good question on internal reconstruction, a very good one, because you can see that it has so many entries, or basically so many items being tested in that particular question. So it's a very good question on internal reconstruction. So let's do the last part of the question. And basically what we are required to do is we prepare a statement showing how the anticipated profit will be distributed among the various providers of capital. In other terms, you can just refer to this as the distribution statement. Statement. So these are statements to show how the anticipated profit will be distributed among the shareholders. So I said the information which we have in note number 10 is what we're going to use in answering this part, together with some of the information which we have here. Can we go to note number 10? We see what we are told. We are told that it is estimated that under the new arrangement, the net profit before interest and tax will be 5 million shillings, 5 million per annum. There will be no tax liability relating to the company for the next 5 years. So basically, we are required to show how that profit will be distributed to the various providers of capital. So whatever you have there in note number 10 is basically profit before interest and tax. The profit before interest and what? And tax. How much is that? It is basically 5 million. 5 million. So the first thing we need to do to this profit, because it is a profit before interest and tax, the first thing we need to less is the interest. Remember, this is the interest, or basically the finance cost. The interest or the finance cost to be paid to the providers of capital. So what we need to do is basically to go back to the balance sheet of our company, specifically at the non-current liabilities, and we see Who are the providers of the non-current liabilities? These are the providers, or these are the providers of capital who should be paid interest. So the company has got issued 14% debenture. So how much interest will be paid to these debenture holders? They'll be paid an interest for the finance cost equal to 14% times the value of those debentures, 8,000. 8,000. So this will give us how much? This will give us how much? This will give us an amount of 1120. So then from there, we will get the profit before tax. The profit before tax. So how much will be our profit before tax? 5,000 minus 1120. It will be 3880. 3880. So that is the profit before tax. Then what you're told in note number 10 is that this company will not pay tax in the next 5 years. So no tax will be paid. So meaning here, we don't have income. We don't have what? We don't have income tax expense. So the income tax expense will be nil. So meaning that the profit for the year, will be this, will be that amount. But basically what we know is that this profit for the year, and that is something we came across in the topic of EPS. So this is now what the company is in terms of paying dividends. Sasa, this is what the company is in terms of paying what? Dividends. We also know that if a company has issued ordinary shares and basically the preference shares, the ordinary shares and preference shares, we know from what you did in company law that the preference shareholders should be paid dividends first. Is that what we know? That the preference shareholder should be paid dividends first before the ordinary shareholder. That's basically what we know. So therefore, what we need to do here is basically to raise the preference dividends. The preference dividend will be 15% of the amount of preference share capital, which is 6,000. 6,000. So that will give us a preference dividend of how much? Preference dividend of how much? 15% of 6,000. Yes, that will give us 900. 900. So we left it from that value. And then we get an amount of what? We get an amount of 29.80. Now, this 29.80, remember, in the topic of earnings per share, we were referring to this as PATOS. This is now what we refer as the PATOS. This is the profit which is attributable. The profit attributable to whom? To ordinary shareholders. So this is the profit attributable to ordinary shareholders. So the company will use that to pay dividend to whom? To the preference, not to the preference, rather to the ordinary shareholders. And basically that's what was required in Roman 2. Basically not Roman 2, but part C of the question, the distribution statement, to show how that particular anticipated profit will be what? Will be distributed out of.